Well, good afternoon, ladies and gentlemen, and welcome to Tradesmart, and welcome to our special Thursday afternoon broadcast of Safety First, how to maximize profits and minimize your risk. Hope you guys are all having a wonderful day, a wonderful afternoon, wherever you are. And I want to start off today with a little bit of a survey and a conversation. And here's my question for you. How many of you have heard the statistic or the statement that 90% of traders lose money? Have you ever heard this statement before? It's a very common statement. A lot of people say it. Have you ever questioned the accuracy of that statistic? That's the real question I think should be asking is, where do they get these statistics that 90% of traders lose their money? And so I went on a little search a few weeks ago and decided I'm going to find out the real answer. What percentage of traders actually lose their money? And you might be surprised to find out what the percentage is. Do you have any idea? Carolyn, do you have any idea what the actual percentage might be? The answer is it's actually only 65% of non-professional traders that are losing money. This was from a Q4 2014 report. They update that quarterly. But I thought that was quite interesting. People like to use these 90-10 numbers, and they like to throw stuff out. And the truth is, what is it? X percentage of statistics are made up on the spot. If I really wanted to go with it, I'd say 78%, The truth is we don't know, but the reality is a lot of statistics are made up. And so 65%, it's not an amazing number, but it's better than most people think. And the thing that I think we should focus in on, and really where this webinar is going to focus in on, is the reality that 35% of traders are making money, and they're consistently doing that. This particular report came from a Q4 reporting from the end of last year, but I've gone back and I've looked, and this statistic has been consistent. Some quarters it fluctuates up to 36, 37%. Some quarters it fluctuates down to 33, 34, but on average it really is right in the middle there at 35%. And so the question that we've got to ask ourselves is, how do I become part of that 35%? A lot of people would look at this and they're like, you can't make money trading the market. I see this all the time. People say, you can't make money trading the market. And the reality is you can, and the statistics tell us that you can. These numbers, you say, where'd those numbers come from? These are direct reports from the brokers of retail account holders, people just like you. Now, while you look at that and you might think to yourself, that's a horrible number, it's not that bad of a number when you consider the following statistics. Are you ready for this? 59.78% of large cap managers, 57.84% of mid-cap managers, let me highlight some of these here, 49.78, 57.84, and 72, almost 73% of small-cap managers underperformed their benchmarks for 2013 and 14. And what's the point here? The point is retail traders aren't doing that bad, even relative to professional traders, the so-called experts who know everything there is to know about trading. So what's the difference? What separates that top 30, 35% of people that are participating in the market and consistently making money, and what separates the other 65%? What keeps the professionals in the game? What allows them to keep trading year after year, decade after decade, where the non-professionals tend to go broke? If you look at the statistics of how many non-professionals go broke, that number is outrageously high. And if you look at the statistics of, professionals who stay in the game, even though they're not necessarily making money, that number is surprisingly high as well. And so what is the distinction here? Answering these questions, that's what I'm going to be talking about today in this webinar. And I'm going to give you some formulas for it. And more importantly, I'm going to give you a system of managing your cash that will keep you in the game like a professional. I've learned these numbers from professional traders, as well as my own trading and my own research that I've done. And these formulas will work. So here's the overview of what we're going to be talking about over the next 35, 40 minutes together. We're going to talk about the non-professional challenge in the world of trading. Then we're going to talk about the risk-reward component. We're going to talk about risk per trade. And I'm going to show you how you can learn more as you start to manage your own accounts and say, hey, yeah, I want to stay in that top 35%, where at the very least I'm staying in the game, but ideally we're making a lot of money trading the market here. So let's talk about the non-professional trader challenge challenge. How do I identify the non-professional trader? The non-professional trader is the trader, like most of you, if not all of you, who are not specifically an institution. You're not trading for an institution. You're trading for yourself. You're trading at home. Some would call you amateur. I think that's a bad title. It's a non-professional. Inside the world of trading metrics, we would refer to it as the retail trader. But it's people like you, people that are trading at home, trading their own individual trading accounts. You're not managing other people's money. You're not working for an institution. You are a quote-unquote non-professional. And as a non-professional, there is a few specific challenges that you run into and that you face. So the number one challenge, the obvious challenge, is the reality that everybody wants to make money. And then, of course, there's the antithesis to that. We got the reality everybody wants to make money, and then we got this problem that every time you lose money, it takes the money away, and this creates the conundrum. How many of you have experienced that little emotional battle that goes on? I want to make money. That's my outcome. As soon as you lose money, you feel like you're getting further and further away from what you want to accomplish. And so if you go a step further, you realize that there's got to be a way that I can move this pendulum. I want to move away from losing trades and move closer and closer to winning trades. So the natural next thought is, if I can just do better analysis, I will increase my wins. And if I can make a lot of winning trades, I will make more money. How many of you have thought about that before? If I can do better analysis, I'll increase my wins. If I can make a lot of winning trades, then I'll make a lot of money. But the challenge that we find oftentimes with non-professionals is they actually will make a lot of winning trades. In fact, statistically speaking, a lot of non-professionals make money on more trades percentage-wise than even some of the professional traders, but at the end of the day, they still see their account balances going down. Have any of you ever experienced that? Are you familiar with that phenomenon where you're making consistently winning trades? Maybe 60 or 70% of your trades you actually make money on, but over time, you see your account balances going down. Well, here's the result. This is where most non-professionals end up. They feel exhausted. You work really hard to learn how to trade, but you're just not seeing the results that you want to see. How many of you can identify with that? Is that something you can identify with, Larry, Carolyn, Elizabeth, some of you guys that are here today? Are these feelings that you've experienced before trading the market? Well, I've got good news and bad news. The good news is you're not alone. The bad news is you're not alone. Everybody struggles with this same situation. So what I want to give you is I want to give you a couple of tips of how you can increase your profitability while maybe not even having to increase your actual number of winning trades. And if you use some of these tricks that I'm going to show you, you'll be amazed at how fast some of your profits can actually start going up. So as we start moving forward, I want to ask you, how would you grade your own trading? And I've done this on a typical school grading scale, and we're going to give you an A if you say, I make more money than I ever dreamed. I'm going to give you a B if you say, I make money, but it's not as much as I think I should. And this is a self-evaluation. There's no specifically right or wrong. This is only for your benefit. You're going to give yourself a C if you say, I make money, but then I lose it and I about break even at the end of the day, or you can say at the end of the month, whatever cycle you're measuring on. D, I make money, but I lose more than I make, and give yourself an F if you say, I can't make any money. And this will just kind of give you an idea of where you are personally, and it gives me an idea of where you are. So I'm not going to read all of your answers out. I'll read them, but I'm not going to tie names to them because I don't want to embarrass anybody. But the first person that wrote in says he's getting a B. The next person is getting a C. We got a B. We got a D. I'm a C. I'm a C. I'm a B minus, says one of you. I'm a B. I'm a D. I'm a B. I'm a C. I got one F. Only one person so far has written an F in here. Most of you are saying B or C with a couple of Ds. I got great news for you. I've got really great news for all of you, including the person who said you're making an F. And one of you said it depends on what month it is. That's an appropriate answer. So here's my great news for you. I can help you. The tip and the trick that I'm going to show you in this next few minutes here will totally change the profitability around. Maybe you don't make money on more trades, but I'm going to show you how to make more money over time. So what if I could show you how to make more money than you ever dreamed of? And of course, you're going to say, wow, that's exactly what I want. That's exactly what I need. What I'm going to show you is going to work regardless of the market. If you're trading stocks, if you're trading options, Forex, futures, every market you trade. And it's going to come to the answer, or it's going to come down to the answer to this question. How many winning trades versus losing trades do you think are needed in order to make more money than you ever dreamed? Have you ever thought about that? What's my win-loss percentage? What should it be? Should it be 40%, 4 out of every 10 trades I make money on? Should it be 50%, 5 out of every 10? Should it be 60%? Maybe it's 80 or 90%? What percentage of winning trades do you feel like you need to make in order to be a winner and to make more money than you ever thought of? Have you ever thought about that before? C. Coulter says 40%. Mike says 40%. Keith says 70%. Carolyn says, I'd like 7 out of 10. 72% says Keith. 70 says Larry. 50 says Ivan Lee. I've got some 40%ers. I got some 70%ers. Looks like we're kind of going two ends of the spectrum here. Thomas says 60%. David's my philosophical one today. He says it doesn't matter how many wins you have if you don't manage the risk. All right, that's a good response. Here's the truth. This will surprise some of you. The truth is 40%. If you can make a profit on 40% of your trades and you can learn to manage your risk, as David says, you can make more money than you've ever dreamed. In fact, you can actually drop that even lower, but 40% is kind of a magic number that works really, really well. Here's the key to it. Appropriate risk management. With appropriate risk management, you can actually lose 60% or more of your trades and still be a consistently profitable trader. So the question then becomes, why am I not making more money? I have students all the time that say, hey, I'm making money on 5 out of every 10 trades, 6 out of every 10. I've got students that make money on 7 and 8 out of every 10 trades, and then they still find themselves losing money. So why would it be that, statistically speaking, we can lose on 60% of the trades, but I'm not making all the money that I want to make? And the answer is risk management. This is your key. Here's what we have found through internal studies that we've done, through surveys with our students. We've found that our students at Tradesmart are great analysts. I'm not sure how many of you are existing students, or some of you maybe are coming in here for the first time, but our students at Tradesmart really understand how to do analysis. It's one of the things that we teach really, really well. What we're seeing with a lot of our students is they will actually get 60, 70, even 80% of their trades in terms of their analysis perfectly spot on. They go out and they place trades that are good trades. They make money. But over time, at the end of the month, at the end of the quarter, they're losing more money than they make. How can this be? How can this turn into a reality like this? A lot of people say, well, the market must be fixed. That's why people say the market's fixed. That's why people say you can't make money trading. And none of that is the right answer. The appropriate answer is it's the risk-reward relationship that we take as traders. So let me show you how this works out here. I want to tell you the story about Judy. Judy comes in January, and she starts placing real money trades for the first time. And as Judy starts placing her trade, she places her first trade of the month, and with her $4,000 trading account, she goes out and makes $2,200. So her trading account has increased to $6,200. That's awesome. Way to go, Judy. On trade number 2, she swings and hits another base hit. She's making another $321. So her trading account is growing, and Judy's feeling awesome about herself. How many of you can identify with Judy? Some of you are like, yeah, I made a lot of money last month. And then watch what happens next. On her third trade, she loses some money. She lost $760, but she's not too worried about it. Because in Judy's mind, she says, I just made $2,200, then I made $320. I'm still making more money than I'm losing. In Judy's mind, everything is going nicely. On her fourth trade, she makes another $220. Not a lot of money, but a little bit. On her fifth trade, she makes $105. Her account's starting to grow again. And then she has kind of a big loss. She lost $1,900. On her seventh trade, she makes another $800. Then she pulls in, kind of a break-even trade. She made $25. Then on her ninth trade, it was a good trade. She made $1,100 on this trade. Her 10th trade, she makes another $650. On her 11th trade, that was kind of a big one. She lost $2,100, kind of a big deal. And then on her 12th trade, she lost $800. And at the end of 12 trades, at the end of a month, Judy's bank account has actually, or I should say trading account, has actually gone down, even though if you count it up, she's only lost 4 out of 12 trades. She's making money more than 60% of the time. Most people would think if you make money 60% of the time that you're going to make money over time. How many of you would have thought that? If I were to say to you, you're going to make 60 or 70% of your trades for a profit, would you think to yourself, I will be profitable? Carolyn, what would you think? 60 or 70%? For a profit? Sure, I'm making money. But here, Judy's done that. And this is a very common story, what I'm showing you here. What Judy has done is she's made more winning trades than losing trades, and she's done it consistently, but at the end of a month, she's losing more money than she's making. How many of you can identify with this? If I were to ask you how many winning trades are you making right now only to watch your account go down, do you have that metric? Do you have that number? A lot of people don't even have the metric, but a lot of you do. A lot of you know, hey, I placed 13 trades last month and I still lost money even though I made money on 7 of them, even though I made money on 8 of them. So this is a very frustrating experience. So what Judy needs to learn, and what you need to learn, if this is describing you in any way, is the relationship between risk and reward. And so that we can common size this, and so we can make it a little bit easier, we're going to refer to this as R's. Just think about it. It's the R of your risk and the R of your reward. This is going to be a measured unit. And what Judy needs to do is she needs to do a phrase that we call common sizing, where she common sizes her risk and her reward, and she stabilizes her returns over time. Let me show you how it works. With the R system, here's what's going to happen. First of all, it's going to be your key to success to managing how much risk you take relative to the reward you expect to make. How much risk you take relative to the reward you expect to make. Now, Carolyn, here's going to be a key that unlocks this for you. Are you ready? It is impractical for you to risk more than $1 to make $2. It is impractical. If you do this, you will go broke every time. If you risk more than $1 to make a $2 trade, or let's say you're going to make $4 on the trade, you can't risk more than 2. We call it your reward to risk ratio, or your risk to reward ratio, however way you choose to order it here. But the idea is that if you're going to risk $1, your reward has got to be a minimum of $2. Ideally, it will be $3 or more, but a minimum of $2. And guess what? Great professional traders know this secret. It took me years to discover this secret. When I did discover it, I was shocked at how simple it is and how blinded I had been to not be paying attention to it. So let me show you how this is going to work. Here's the principle. You've got a certain amount of capital. I don't know how much money you got. It doesn't matter. It doesn't matter if you have $3,000 in your trading account or if you've got $300,000. Regardless of where you are, regardless of how much money you've got, you need to apply this principle. Every professional trader, really good professional trader, applies this principle. They recognize their starting capital. They take that capital and they're willing to take a percentage of it. We'll call it an R unit, a risk unit, a unit of risk that we're willing to put out there. And then we're going to go buy some equity. We're going to go buy some stock, or maybe you're going to buy some Forex, or maybe you're going to get into a futures trade, but you're going to go place the money into a trade. And before you even get into that trade, you have an expectation that if this trade does what you think, you're going to have this particular reward. Now, what I've drawn out on the screen here is we're going to risk 1 unit in exchange for 3 units. We would call that a 3-to-1 reward to risk ratio. We're going to risk $1 to make $3. You see how this works? Now, this changes everything. This changes the whole game. Let me show you the statistics and the percentages and how everything's going to work out if you play just with this one metric in your trades. If all you do is mess with the reward to risk, watch what happens. Let's say that you're a 50% trader. Let's say that half of your trades you make a profit, and half of your trades, you lose a profit. So we're going to say on 50% or 50-50, okay? Half my trades, 5 out of 10, I make money. 5 out of 10, I lose money. Let's watch what happens. Here's my risk and my reward ratio at the top. Here's how it's going to work. We're going to risk $1 to make 50 cents. Risk $1 to make 50 cents. If you win 5 out of 10 trades, that's 50% of your trades, we're going to multiply 50 cents times your 5 winning trades. That gives you how much profit? $2.50. So congratulations, you made $2.50 per share. Now, let's say you are trading multiple shares, which I'm sure you are. Obviously, the actual cash is going to be higher, but I'm keeping this in a per share allotment here so we can keep the math really, really simple. Okay, so on 5 out of 10 trades, you're making $2.50 per share. But on 5 out of the 10 trades, you're losing $1. Well, how much does that equal? That equals a negative of $5. That means that you actually go out, you beat market odds. Basic market odds are 1 out of 3. You're beating market odds by going 50-50. And at the end of the day, you're going broke because you're losing $2.50 a share. You can't take this forever, can you? It doesn't matter how much money you start with. If you take a consistent reward to risk ratio of 50 cents for every dollar that you're going to risk, eventually you will go broke. There is no way to outrun this. That's why it's so important that you understand this percentage here. Now, what happens if we change that? What if we just go 1-to-1? You say, well, if I just go 1-to-1, certainly I'll break even, right? On 5 of my trades, I make $1. On 5 of my trades, I lose $1. So on 5 trades, I made 5. On 5 trades, I lost 5. I must be breaking even. Well, sort of. But remember, you're still paying your commissions. Now, commissions are not such a big deal like they used to be. I mean, you're not paying a couple $100 for your commissions. Instead, you should be paying probably anywhere from $1 or $2 up to maybe $15, maybe $20 per trade. But still, it eats into your capital a little bit. And if you just do a 1-to-1 reward to risk ratio with your trades, over time, you're going to be losing money. Even though you're kind of breaking even, you're losing money from the commissions. And so that's why we say the first place you can start to really make money is a minimum of 2-to-1. If on 5 out of your 10 trades you make $2, guess what? You just made $10. Wonderful. Now, in the next 5 trades, let's say you lose $1. On 5 out of 10 trades, you lose $1. You've lost $5. Over the course of 10 trades, over time, you're going to be making $5 a share. That's why 2-to-1 is a minimum reward to risk ratio that you can use. It's much better to go after a 3-to-1. Watch what happens. If you use a 3-to-1 reward to risk ratio, on 5 of your 10 trades, you make $3. You brought in $15 per share over 10 trades. You still only lost $5, and you're making $10 per share. If you increase it to 4-to-1, watch what happens. You're making $20 at the end of the day. After all your losses, you're making $15 a share. If you can find 5-to-1 reward to risk trades, guess what? $25 in your pocket. You're only losing $5, and you're making $20 at the end of the day. This is the benefit of recognizing the reward to risk ratio. Now, here's what I have found. What I found with our students, what I found in my own trading whenever I finally started to discover this, is I was consistently taking trades where I would only make 50 cents, or maybe I would make 85 cents, and in exchange for that, I was risking $1, or maybe $1.20, or $1.80. And while I would make money on a lot of trades over time, I was having some struggles. This formula solves all of that. If you will limit yourself to making a minimum of 2-to-1 and ideally 3-to-1 or better, then over time, even though you have some losing trades, you will make more money than you lose. Here's what happens with this type of trading. This is a way of stabilizing your wins and your losses. With this type of trading, Even if you're only making money on 40% of your trades, you're going to start to see really good returns. Over any given 10 trades, certainly over any 20 trades, you will start to see consistent profits building up. If you're making a lot of winning trades, if you're making 60% of your trades for a win, you're going to be making a lot of money. You're going to start to see, wow, my profits are stacking up. And many of you, if you've already been our students for a while, you've already been seeing 50 or 60% of your trades turning into winning trades. It's just that over time, you've been losing some money on them. Carolyn, this is your key right here, Carolyn. Carolyn wrote in, she said, my trading comes in waves. I win every time, and then I seem to lose every time, back to back. Carolyn, this is going to be your key right here. And then, of course, if you're making money on 70 or 80% of your trades, first of all, you're doing really, really well. Congratulations if you're making money on that many of your trades. But secondly, you're going to start to see the profits really stacking up very quickly. All right, so let's take a look over here and talk about some of the benefits of ARS trading. Number one benefit of trading with the ARS system, it removes the emotion of risk. You know over time, this is what I'm going to be doing. You know, okay, I'm going to place 2 or 3 winning trades. I'm probably going to place 2 or 3 losing trades. But over time, over any 10 trades, over any 15 or 20 trades, I am making money because I'm managing my reward to risk ratio. The next benefit of the ARS trading system is it provides a predictable system for making money. That's what everybody needs in trading the stock market. You know, one of the things that's comical to me, truly comical, about the stock market is how many people come into this market that by nature is a marketplace of uncertainty, and how many people come into this marketplace with a desire to create certainty financially, yet they're playing one of the most uncertain markets in the world. And so what a system of management like the ARS trading will do for you is it will create a predictable system of making money inside those trades. It becomes very forgiving to less than perfect analysis. You know, a lot of people feel like I've got to go make money on all my trades or on 70 or 80 or 90% of my trades in order to make money over time. Well, with ARS trading, you do not. With ARS trading, if you limit yourself to a 3-to-1 reward to risk ratio, you can actually perform at exactly basic market odds, making money on 1 out of every 3 trades, and you will still make money over time, just limiting yourself to a 3-to-1 reward to risk ratio. So it's very forgiving to less than perfect analysis, and it allows you to stay in the game longer, which of course is what each of you want, and of course it's a great way to put money in your pocket over time. This is the type of systems that professional traders who even maybe are not making money as frequently as you are, this is the kind of systems they put in place so that they can make money over time. Now let's check out what happened with Judy. We saw Judy's trades here. She placed 12 trades. 8 of them were for a profit, which meant 66%. But at the end of the month, she had a $139 loss, which was 3.5% of her overall account value. Now, let's compare that to another trader, Cindy. So in the same month, Cindy came along. She also started with a $4,000 trading account. And the first trade of the month, great, she made $400. Not a lot of money, nothing compared to Judy's $2,200. But she made $400. The next trade, she lost $200. On the third trade, she lost $175. On the fourth trade, she made $520. Again, not a huge win, but steady. On the fifth trade, she made $300. On her sixth trade, she lost $190. On the seventh trade, she made $600. On her eighth trade, she lost $25. On the ninth trade, she made $185. She made $850 on her 10th trade, and by her 11th trade and her 12th trade, she was losing money again, losing $200 and $100. If you count up these wins relative to the losses, Cindy only made money 41% of the time. Most people would think that's an astounding statistic. She's only making money 41% of the time. However, she made a profit of $1,500, representing a net gain of 39% for the month. What's the difference? Most people would look at Cindy compared to Judy, and they would say, Judy made a lot more money on some of her trades. Some of her wins were $2,200. Judy had more winning trades. Judy's winning big, and she's winning often. but Cindy's making money. What's the difference between Cindy and Judy? And it comes down to this. Cindy limited her risk. She manages the risk-reward ratio with absolute pig-headed discipline. She has more predictable results, and at the end of the month, she gets a 39% profit versus a 3.5% loss. The distinction here, Cindy went through our R's trading program and she learned how to manage her risk and her reward. And the ultimate benefit for Cindy is she sleeps really, really great at night because she knows over time I'm going to be making more money than I'm losing. So let me show you how the R's trading is going to work. I've given you the principles and theory. Let me lay it out for you on a chart and show you how this starts to work, okay? So Carolyn, here's what's going to happen. Let's say you're looking at Starbucks. And as you look at this trade, you see that this trade is pulled back a little bit. You're going to buy the dip, as so many people like to do. And you go ahead and you set yourself an entry in here. And you say, if this trade moves above $55 a share, then I'm going to go ahead and get into the trade. I'm going to buy it. All right, well, where's my next target going to be? Well, first, let's set our stop. Our stop's going to be below our support level down here. So we'll put our stop in here at 52.50. Okay, so that establishes our risk amount right there. And now we're going to come in and we're going to set our target amount. Well, we're going to set our target in a minute. That's our risk amount right there, $2.50 per share. Let's say we do $100 on that. Here's our target. I knew I had my target coming in. Sorry about that. So here's our target. It's going to be up here at $62. That was our recent swing high point after our current swing high. And let me explain that a little bit. This current swing high could be a risk. There is a possibility that the trade is going to stop there. But if you look at the cycle of this, you recognize that this is probably, if you understand your wave counting, this is probably a third wave. The probability here is that the trade will go on up to the preceding high before that. So that's how we measure that there. All right, so we're going to measure this. We're going to say our entry to our stop, that is our risk unit, and that's how you define risk. Risk is always, I'll put this up here, risk equals entry minus stop. So the difference in entry and stop, that's always your risk, and your reward level is always going to be your target minus your entry. Okay, your target minus your entry. So let's count this up here. If we enter at $55 and our target is $62, check this out. We've got approximately a 3-to-1 reward to risk ratio. We're looking at this and we're expecting this trade to go out and make us $7 for a $2.50 risk that we're taking on here. You see how that works? And so what we're making here is we're making a predictable move. Now, when you learn to manage your reward to risk ratio like this, your profits are going to soar. They're going to start taking off rapidly. And the reason is because when you do lose money, and you will lose money, it's a myth to think that you're not. You have to plan for it. And so when you do lose money, you're planning on taking the established risk amount. And when you make money, assuming everything works like you expected it to, you will make the reward amount. And over time, the rewards will outweigh the risks, and it will average out, and you will have a more smooth profit margin and a more smooth, profitable trading account that follows you here. This one tip right here is quite possibly the most important thing you can learn in terms of risk management and learning how to trade safely. I titled this webinar, Safety First. This is the way you start to do it. You start to manage your risk. Now, I've got one more technique I'm going to share with you here, and then we'll wrap it up. This is the risk per trade. The one we just looked at is the risk reward. How much money am I risking for the reward? Now we're going to talk about overall account risk relative to the number of trades. So everybody agrees you can't risk everything on one trade. This becomes trading suicide. Carolyn, one of the reasons you might have seen the yo-yo that you've seen. You go out, you make a bunch of money, and then you feel like now I've gone through a season where I lose on all of my trades back to back. Well, the reason that that cycle will wipe people out is even if they're using a good risk reward, that cycle will wipe people out if they're not doing a good risk per trade. And so here's the way risk per trade works. The way it is we're going to measure and we're going to manage how much risk we're putting on the line for each trade. How much of our overall trading account that is. You can't risk everything on one trade. It's going to be trading suicide. The less you risk, obviously, the longer you can trade. So the question is, how much could I risk? How much should I risk? The general answer is not more than 5%. This is the top end of the spectrum. Some people will go to 10%. I generally suggest that you try to keep it down to 5% or less. More conservatively, 1 or 2%. And here's what I have seen. My general understanding of this and or perspective of this, I should say, interpretation, whatever you want to say. The way I look at this is the smaller your account capital, the more you're going to have to risk. So if you've got a $5,000 trading account, you're going to have to risk closer to the 5%. If you've got a $100,000 trading account, you can get away with risking 1 or 2% of your account. You're going to see your overall profits go down a little bit, but you'll see your consistency of keeping your capital go up. And that's really what you want. So, how much you risk per trade is probably going to be impacted by the size of your trading account. But let me show you what I'm talking about here. Let's say you've got a $20,000 trading account. If you got a $20,000 trading account and you risk 5%, that means that your R's unit can be up to $1,000. Up to $1,000. That's 5% of your overall trading account. So whenever you look at your risk to reward, your risk, we'll put this on the right side, is going to equal 5%. So the difference in your entry and your stop needs to be no more than $1,000 if you have a $20,000 trading account. Now, here's the good news. You can stay in this game for up to 20 trades before you go broke like that. Now, most of you, if you're doing the R's trading, if you're doing a good risk and reward ratio there, and if you've done good analysis, very few of you would have a possibility of trading 20 trades back-to-back that are losing trades. If you do, if you get to number 10 and you've lost 10 back-to-back, you probably don't need to place number 11 before you figure out why you're losing money. You see what I'm saying? I mean, 20 is a lot of trades to do back-to-back without having some winning trades in there. Now, if you want to go a little bit lower, if you do a 2%, here's what it looks like. Your risk unit becomes $400. $400 is all. And guess what? That's going to keep you in the game for 50 trades. Maybe you might be the outlier who can actually lose 20 trades back-to-back and you'll be willing to take that pain. But I can't imagine that you would lose 50 trades back-to-back. Now, if that's something that worries you, well, you can go down to 1%. You're only risking $200 per trade, but you can stay in the game for up to 100 trades. You can actually lose 100 trades back-to-back. Now, if you're doing a good risk-reward and you're doing a good account risk per trade management, there's no reason that you need to go broke. There's really none at all. What if you've only got a $10,000 account? Well, if you got a $10,000 account, the 5% becomes almost a mandatory thing here. You can only risk $500 per trade. You can still stay in the game for 20 trades, obviously. 2% means you got a $200 per trade risk. 1% means you only got a $100 per trade risk. And obviously, it's going to get more and more difficult to find trades where you can make any money and only risk $100 on it. If you go down to a $5,000 trading account, 5% is probably what you're going to have to risk on it. This is what I have noticed. That puts you down to $250. Now, you can do that with some option trades. You can do it with some smaller cap stocks. That's what you're going to be limited to. You're not going to be out there trading Google if you got a $5,000 trading account. But even if you have a smaller trading account, limit yourself to 5% of your overall account for your risk per trade, and you can stay in this game for up to 20 trades and keep moving along there. Now, let me show you a way you can extend this, and this will actually give some of you even more comfort here, and you realize that there's no reason you have to be afraid of going broke. What if, instead of just risking 5% on your initial account balance, what if we scale it? Here's how we scale it. You ready for this? Let's say you start off with a $10,000 trading account, and you risk 5%. That means on this one trade, you can risk up to $500. You lose on that trade. Your new capital balance is $9,500. We're going to base our 5% off of that number. So now our account balance has dropped down to $9,500, 5% risk. The most we can risk on this trade is only $475. Let's say you lost on that one. Now our new account balance is $9,025, okay? So 5% of that, The most we can risk on this trade is $451. We lost on that trade. You see what's happening. Our account balance is going down, but so is the amount that we're willing to risk per trade. And if you will scale like this, guess what? You can take this far out, way past the 20 trades. You can go all the way down 27 trades in a row. 27 trades in a row that you lost. You still have money. You can go 36 trades in a row. Now we're starting to get to where you hardly have any capital left. But, you can go 30, 35 trades back to back, still have some capital where you go out there, you still have a little bit you can risk, and you could lose all those numbers in a row, which is ridiculous. That's why the whole reason I show this to you. I mean, I can't imagine any of you are sitting there thinking, yeah, I'm going to be the one that goes and loses 36 trades back to back. That's ridiculous. There's no reason for you to do that. If that's where you feel like you are, then, let's help you learn how to do better analysis. But the truth is, nobody who goes through our foundations program, many of you have already done that, nobody goes through our foundations program and they apply it should come out on the other side and actually be able to lose 36 trades back to back. It's next to impossible. If you keep scaling like this, though, theoretically, you can keep going forever. It starts to become impractical, but you could theoretically keep doing it forever. Here's the point. The point is there's no reason that you have to go broke. You've got just as much potential as any professional trader out there. But as a non-professional, what happens is we don't often put ourselves into the same category. Consequently, we don't put ourselves into the same discipline. If you were to go work at an institutional firm, what you would find is before you could place a trade, you would have to answer these questions. You'd have to say, how much of my account am I going to risk? You'd have to say things like, this is where my target is. This is where I'm willing to get in. This is where I'm willing to take my loss. And you establish those things before you get into the trade. Most non-professionals will never do that. So by now you've certainly seen what a professional would do. You start to see how they can manage that risk. Guess what? You can do it as well. Here's the key. The key that distinguishes professional traders from non-professionals is risk management. It really is the key. If you will just do these keys that I've given you today, risk and reward. If you'll make sure that you're making a minimum of $2 reward for every $1 you risk, you'll stay in the game and you'll be able to keep doing this year after year. If you'll manage your risk per trade to 5% of your account, you'll be able to stay in the game. These two details right here will keep you in the game year after year. And there's no reason that you have to go broke. So if you're like most traders, you're probably feeling a little bit beat up by the market. How many of you would identify with that? How many of you feel a little beat up whenever you think about trading, when you think about the market here? Maybe you're wondering to yourself, is this real? Can I really do this? Most people ask these kind of questions. So what I want to do is I want to encourage you. I want to encourage you, not with my words. I mean, obviously I can tell you stuff, but I want you to see real people like you posting their real results, okay? So these are not, I can't make these up because they came into our social network where people are sharing with other people. And Rob says, hi, Michael, I haven't talked to you in a while. I just did my first real money trade on January 29th, and his account's currently up 50%. Okay, and the reason? Because he's using all the risk-reward tools, he's using the analysis tools, everything that we've taught him how to do. Check out what Angie says. Angie says, risky business is super terrific risk management. That's the key. It's strategies for swing trading as well. The lessons are completely applicable, and it's a must. It's not talking about her results, but it's talking about the risk management principle here. Watch what Ruth is doing here. I think Ruth is next. Yeah, Ruth is next. Watch what Ruth has done here. She says, she wants to tell us that the program Foundations of Stocks and Options, I've been paying for both my younger son's current college tuition and my older son's college loan since last summer. So in other words, this is not a one-time hit. She's been doing this over and over. She says she's making between $5,000 and $8,000 a month. All right, so good for her. Now watch what else she shared with us here. She says she wants to reiterate that she's glad she found us. Learning to trade options has taken away a lot of her anxiety. Some of you need to take some anxiety away about paying for her kids' college tuition and retirement. And I thought this was interesting. She went on to say that her husband's been trading options for 8 years, but is not as consistent as her. And he's amazed by that because he relies on a totally different trading system. Here's the point. The point is it does work. Risk management is the key. And if you don't already have an analysis background, then analysis is going to be one of those keys as well. I'm kind of going on the assumption here that most of you have some analysis background, but we'll teach you all of that. It's all included here with your memberships at Tradesmart. So let me share with you how you can learn more. The stuff I have talked about today is specific to risk management. And where you're going to find that is in our trading program, Risky Business. This is a program that's included with your membership. Here at Tradesmart, this is where you're going to learn the risk management and the R's trading, options and R's trading, how to manage your risk with your option trades. This is where we're going to talk about trade management and equity sizing as you look at your overall account and how much you should put into a trade. So this is the program that you're going to want to go look at. Now, if you're already a member, great. Just go log in, go watch the Risky Business videos, and you'll be set up. Some of you are not members yet, and some of you didn't even realize this was available. So Risky Business is one of the programs that's included, but so are all of our other training programs, our Foundations of Stocks and Options, Fibonacci Trading, Japanese Trading Systems, Tick by Tick. Wherever you are in your trading journey, we've got something for you to help you move to the next level. So if you don't mind, let me talk really fast here about the memberships, and I'll kind of give you an overview of what you've got access to as part of a membership. When you're a Platinum member, this is where most of our students actually come in because they kind of like to have access to everything. But when you're a Platinum member, you get all of those core training programs. They're all included, including my new program. It's not even up on your screen, but my new program coming out next week, Bollinger Band Essentials. So if you've been wanting to learn about Bollinger Bands, that program is included as well. Now, as a Platinum member, in addition to all the core training, you also have access to our weekly trading labs that we do on Monday, Tuesday, and Thursday, as well as our Mastery series that we do monthly and our Power Trader that we do weekly. So I'll write this up here on the screen. Power Trader is weekly, every Sunday night. Mastery series is monthly, and Trading Lab is 3 times a week, 3 nights a week. Okay? Now, these are all live programs. The core training is all on demand. You can start watching it anytime you want to. But as a Platinum member, you have access to all of these live trainings as well. And that's why so many of our students like to start off as Platinum members. Now, for some of you, you may say, hey, I can't do Sunday night Power Trader. You know, the monthly mastery is not as important to me. Well, if that's okay, we've got the gold level of membership. A lot of students come in at this level. It's all of the core training, and you still get the live trading labs on Monday, Tuesday, and Thursday. It takes out Power Trader. There's no Mastery series, but you still have the trading labs on Monday, Tuesday, and Thursday. And then finally, for those of you who say, you know, live classes are not for me, we have our Silver membership where you can have access to all of the core training, all of the on-demand classes. It's just none of the live classes. The live classes are great because they support you as you're in your learning process, but for some of you, the timing, the schedules, it doesn't all work for you. And so you know, we've got the Silver membership available for that. Whichever way you choose to come in, it's going to serve you. It's going to take your trading to the next level. Now, here's the really cool thing. For those of you who are not already members, we've got a great offer for you. You can go to our website right now for a limited time. You can try everything. That's Platinum. You can try everything for just $4.95. And then if you decide, hey, I want to continue, then you can go on the regular monthly membership here. But there's really no reason to not go ahead and unlock everything, give it a trial for 30 days for just $4.95. All you need to do is go over to tradesmartu.com, and it's right there on the homepage. Just click to become a member and to start your trial. Here's another quote from Mary and Tracy. She's talking about Risky Business, says it's really put me on the leading edge. This is what the risk management's done for them. When Alfonso brought forth the R's and I started using it, it really changed my trading completely because now I know exactly how much I'm going to lose. Whichever way it goes, it's not going to worry me. You see, that's what matters. The reason people get emotional about their trading is because they're afraid that if they take a loss, it could wipe them out. But if you know exactly how much you're going to lose and you know exactly or approximately how much you're going to make and you've measured these metrics and you know over time I'm going to make money, well, it takes that fear out. That's exactly what Mary and Tracy are saying. I'm not going to lose any sleep at night worrying about what's going to happen tomorrow. So for those of you who feel like, managing your trades is the way to go, risky business is the class for you. Again, it's part of your core membership. Just go right on over to tradesmartu.com and you can go ahead and get access to that. When you go to www.tradesmartu.com, you're going to see this page on our membership page or on our home page, and you just need to click on the Learn More for $4.95. You can just click on that and it'll give you some more information. And then once you've signed up for it, of course, you're going to want to get logged into your membership area. So here's where you'll do that. Up here where it says sign in here, you'll click on that, and that will take you into the membership area. And if you need any help, we've got our student success coaches standing by, waiting to help you get signed in. In fact, one of them's here right now, Michael Longenecker. He'll be happy to get on the phone with you or do whatever it takes to help you understand better what you need in order to get going here. So I want to thank you guys for giving me some time today. I hope that what I shared with you illuminated some ideas about risk management, and hopefully it gave you some ideas about some of the classes you've got available here at Tradesmart as part of your membership. So I look forward to seeing some of our other live classes, and until we meet again, happy trading to all of you. Good afternoon.